Identifying the controlling trend is very, very important. It massively increases your chances of trading and investing success.
We're setting a bit of a historic precedent here. Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Welcome everybody to another episode of Talking Trades. Of course, you have Kevin Wadsworth and myself, Patrick Karim. And guys, we got a good one for you today. Kevin will be talking about trends. And remember that old adage, the trend is your friend? Well, goodness, it might seem boring. It might seem it can't be that simple, but Kevin will 100% highlight that it is that simple and it is that important. And always, always respect the trend and you'll be far off ahead everybody else that's trading. Kevin, I hope I don't put too much pressure, but I'm pretty sure you'll be able to showcase this as being true, right?
Yeah, sure, Pat. Well, I think you've probably heard that phrase, the trend is your friend, and it sounds very easy, doesn't it? I suppose it does apply for longer-term investors, perhaps a little bit more than short-term investors. But if you're trading on an hourly time frame, I guess you can apply the same methodology. And in fact, it is important that you look at higher time frames. I'll explain what I mean by that in a moment. But the trend really is your friend, regardless of the time frame that you're trading on, whether you're doing intraday trading, whether you're holding your positions for a number of days, weeks, or even months. Identifying the controlling trend is very, very important. It massively increases your chances of trading and investing success. So probably the best thing I can do is share a chart and show you what the heck I'm talking about. It's always good to try and simplify things, and trading is a case in point for that. So what we've got here is the gold chart, okay? And we've got only one thing on the chart actually at the moment, and that's the something called the Ichimoku cloud, which is a Japanese technical indicator. It projects forwards support and resistance using current and past price action. And something that jumps out at you from the screen, I hope, is that during a strong uptrend, and this is where we're talking about the trend, you are above the Ichimoku cloud. All of the price action is taking place on this monthly chart. It's a monthly chart above the Ichimoku cloud, okay, until it isn't, okay? So if you wanted to, you could simply enter when you get a clear and convincing breakout above the Ichimoku cloud and exit when you get a clear and convincing breakdown. Okay, you don't catch the very top and you don't catch the very bottom, but you're increasing your probabilities of not ending up making a loss. Now, if we go back to the previous bull market, it's much the same. You can see back in the 1970s there, all the way through to 1980, the bull market took place above the Ichimoku cloud with one period there where it threatened to break below, but it didn't. And then apart from those two bull markets, the rest of the chart is taken up with choppy price action that tried to break out above the cloud, but failed. Now, there's a way of identifying that was not an entry point. And as a way of identifying that is an entry point in the early 2000s. I'll move on to that in a moment. But if we move forward to the current price action, we got a clear and convincing breakout above the Ichimoku cloud. And that 3-year hiatus where the price of gold didn't do anything exciting at all was just allowing the price of gold to reconnect with the Ichimoku cloud. It had moved too far, too fast, really. And we had effectively more of a sideways correction than a deep downwards correction. But it was very frustrating for precious metals traders. But for those of you with a long-term perspective, it was just a case of sitting on your hands and letting it play out. Of course, you can look at technical analysis to find instruments that are outperforming gold during this period, and you can trade those markets. But if you're a long-term investor and you don't want to be trading, then you're okay as long as you still have the trend as your friend. Okay, I'm going to take off the Ichimoku cloud for a moment, and I'm going to put on the 4-year moving average. Okay, and why the 4-year moving average, you're probably saying? Well, because gold has a 4-year cycle. Okay, it has an 8-year cycle and it has a 4-year cycle. So you'll find that the 4-year moving average is quite significant for the price of gold. Okay, price can come down and test the 4-year moving average in a bull market. So again, a little bit like the Ichimoku cloud, you'll notice that bull markets occur above the 4-year moving average. We violated the 4-year moving average in 1976, so you could easily have taken the decision to exit the gold bull market, wait for this drop to play out, and then re-enter on the breakout and the back test, and you're back above the 4-year moving average. So by doing that, the trend is your friend, okay? And there's a whole period here during the 1980s and the 1990s when the trend was really not your friend, because there wasn't a well-defined trend. There were periods in time where you might have thought, yeah, we're breaking out, I'll take a position. Now, do you remember I said that there's a way of knowing when to take a position in precious metals and when not to take a position in precious metals? And that is by using the gold to S&P ratio. So this is part of identifying the trend, okay? And part of identifying whether or not the trend is your friend. And because gold and stock markets move counter to each other, so when stock markets are in a prolonged down phase, gold does well, and when gold is in a prolonged downward phase, stock markets do well. So the gold to S&P ratio tells you when you should be looking at positions in gold and when you should be staying well away. Now, that period during the 1990s that I spoke about in the previous chart, where you can see that you might have been tempted to take a position, 1986, again in 1993. Well, if you're looking at the gold to S&P ratio in 1986, you would not be taking a position, because in 1986, the gold to S&P ratio was not breaking out. Here we are, 1986 here. So the gold to S&P ratio is not breaking out strongly. It is broken down, and it has not broken out above a significant horizontal breakout level. This was a little blip in 1987 there, where the gold to S&P ratio moved up, but it did not break out in any meaningful or significant way. And the same thing currently, actually, the gold to S&P ratio has not broken out in any real meaningful or significant way. And that's really why the gold and precious metal miners are, or particularly the precious metals miners, are not going to the moon at the moment. So by using the gold to S&P ratio and by using the moving average and the Ichimoku cloud and identifying the trend, you can, as I say, clearly identify when the trend is your friend, and then you can have a high degree of confidence in taking those trading and investing positions. And that's it, Pat.
That was brilliant. Always want to ride those trends, and if ever they unravel, then you step aside until a new trend comes along. Guys, thanks for watching. Make sure to like, subscribe, and always get more stuff, more good analysis from Kevin and I. Thanks, everybody.